All right. I'd like to take this opportunity and discuss question number 3 on your chapter 4 homework. Okay. Um, if you have not attempted, please pause the video and try to finish all the steps before you continue watching the video. All right. Um, let's look at this question here. So the company is considering buying a new machine for one of the factories, right? So it's a capital budgeting problem. The machine cost is 100,000 and expected lifespan is 8 years. All right, the machine is going to reduce the production cost by $15,000 per year. So that's the savings. The terminal value of the machine is 20,000. Okay, so that is the book value. All right, but the company believes that it would only manage to sell it for 10,000. So this 10,000 here is the market value because that's what the machine can sell for at the end of 8 years. All right. If the appropriate discount rate is 15% and the corporate tax rate is 40%, all right, what is the NPV and what is the IRR? All right. So the analysis here is this is a capital budgeting, all right, with taxes and depreciation, okay, and book value and the market value and so on and so forth. All right. So we know what we need to do. All right. So we need to examine the after-tax cash flows. All right, and calculate NPV. Okay, and use that to decide. All right. So I'm going to build a timeline here. All right, and this is actually for 8 years for the machine to operate. Okay, so I'm going to build a 8 period timeline here. All right, and let's look at the cash flow per period. All right, so in period 0, you're going to invest in the machine, so that is negative $100,000. Okay, is it 100,000? All right, I think that's too much. 100,000. Okay, and let's look at the other parameters here. All right, savings per period. Okay. Well, actually, I want to just leave a few rows blank here. I want to organize my thought here. All right, savings here is 15,000 every year, and lifespan is 8 years, as we did for the timeline. And so we're looking at terminal value. That is 20,000. Okay. So if that's the case, then we know that annual depreciation. All right. So this is actually where some of you might be confused. All right. So you're looking at the machine cost. That's 100,000. Okay. And you look at the end of 8 years, the machine is still worth 20,000. So that means the machine will be depreciated, for a total of this amount here. That's 80,000. And you're going to have 8 years to do the depreciation. So the straight line implies that your annual depreciation is 10,000. Okay, so this is critical, right? If you want to produce the correct answer, this is the annual depreciation. All right, and then you also have the market value. Okay, residual, market value here, and that is only 10,000. So in this case, all right, the terminal value here, I should say terminal book value. All right, this is what the machine is worth, on the accounting book. Right, so that is 20,000. So really, the company is going to have a capital loss, and the capital loss is, the 20,000 book value minus the market value of 10,000. So they're going to have a capital loss of 10,000, and they're going to have essentially a tax credit in this case. All right, so the tax credit is going to be the $10,000 capital loss times the tax rate, which is 40%. Okay, all right, so if that's the case, we can now think about the after-tax cash flows in this case. All right, so when you look at the first year here, you can have the annual savings, this amount here, and you're going to take out the depreciation, so that's the amount here. And so I'm going to do I'm going to pay tax. So one minus the tax rate, which is 40% here. And because I took out depreciation earlier, so I need to put back depreciation. All right, so I'm doing essentially the second approach for calculating the after-tax cash flows. All right, I took out depreciation and I put it back. All right, and I need to lock down all the cell reference here. All right, so if I do that, I get $13,000 cash flow every year, and I drag this across. And now in year 8, I have to think about this is where the machine is going to be, having a residual value, and the residual value is actually, market value. So they can sell the machine for 10,000, but at the same time, they're also going to claim a tax credit of 40,000. So that is going to be, another 4,000. Except tax credit is another 4,000, not 40,000. All right. So if that's the case, this is the cash flow, at the end of year 8. All right. It has the annual savings, um, minus the depreciation, and then you pay tax, and then you put back depreciation. That's the first term here. All right. That's this term here, and then you also have the market value of the machine, so you can sell the machine for only 10,000, and because you realize the capital loss, so you're going to claim a tax credit, right? So, that is 27,000. So if that's the case, I can go ahead and calculate my NPV here. All right, so I'm doing the NPV calculation here. The discount rate is 15%, and I'm looking at all these future cash flows, and I'm putting back the initial investment. All right, so that is the $37,088 answer you saw on your homework. Okay, if I want to calculate IRR, I can certainly do that. All right, so I can take the IRR function, and I take all the cash flows, including the initial investment. All right, so that is 3.50%. Okay, all right, so this is really a little confusing to many of you because you have the non-zero book value, you have the non-zero market value, and you have the difference. So if you have a capital gain, you pay tax. If you have a capital loss, you actually have a tax credit. All right. So I hope this is useful. I'll stop the video here.